Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, or should I say, welcome to another episode of Equity Mates. We're young, we're reckless, we'll take this too far. Whether you're a newbie in the financial world or you're already feeling 22, we're here to guide you through the ups and downs of investing. So grab your guitar and let's strum the chords of financial success together. As always, I'm joined by my equity buddy, Ren, and who am I?
You, Bryce, are Taylor Swift.
Correct.
And it's fitting that you've chosen Taylor Swift. I'm going to hazard a guess that you didn't choose Taylor Swift, but producer Sasha chose Taylor Swift.
Yes.
She told us a couple of days ago when Spotify Wrapped came out that, unsurprisingly, Taylor Swift was her number one artist.
Yes. And with number one artist, and I think the song was played over more than once a week.
That's actually not surprising.
Well, yours is like 22 or something.
I'm feeling.
I find
my number one song was played 22 times.
Something like that.
Yeah.
Yeah. I reckon weekly is a big lift.
A very diverse taste in music.
Yeah, weekly. Sasha, if you want to tune in here, you can. But weekly is a big lift, I reckon, for a same song 53 times. How'd you manage that?
Yeah, I feel like I got a sideswipe there from Ren being like, my music taste is very diverse. I listen to other things. I just love Taylor the most.
No, I respect it. I think weekly is solid effort.
So I just asked Bryce what his was, and
I don't have Spotify. I could look up my wife's Harriet because I use it through that. But
let us. What's your top YouTube? Track 16, 14, Untitled. Club mix.
Anyway, I have to download it, so I'm not going to bother.
Okay.
By unknown.
Anyway. That is not what we're here to talk about. Save it for the music podcast.
Yes.
We are here for the final time on 2023 for an Ask an Advisor episode. This has been a new style of episode that we've launched this year, and it's been an absolute cracker. We've loved it. And judging by the volume of questions we've been getting through to ask@equitymates.com, it's been a favourite in the community as well. It's our opportunity to put our questions to some of Australia's best financial advisors. And once again, we're closing out the year by putting your questions to a financial advisor in the hot seat.
That's it. And it is our pleasure to bring into the studio Jelena Koncar. She is a senior wealth and holistic advisor at Shaw & Partners. And we've got three sort of buckets of questions today, investing related, superannuation related, and then a few general ones to close out around debt recycling and how to approach Christmas and those sorts of things. So very much looking forward to this one. There's a few questions in here that I'm going to probe a little bit deeper on as well for my own personal circumstances, which is what I also love about these. We get a free financial advice session every time we do it, Ren.
Well, on that note, Bryce, we should remind everyone that whilst we are licensed and while Jelena is licensed as well, none of us are aware of your personal financial circumstances. So whilst you might think of this as a free advice session, it's important to stress it's a free general advice session, not personal advice. And if you want to keep the general advice train rolling after this episode, an important reminder that we have 2 books out. Get Started Investing, Don't Stress, Just Invest. Great ways to continue your investing journey. And also great gifts. If you're racking your brain trying to think what to buy this Christmas for the person that has everything, give them the gift of financial security. Give them one of our books.
And I'll tell you one thing, Ren. It is on an almighty sale at the moment on Amazon. Not that I'm choosing between platforms where to buy, but I think it's about $15, which is almost half price.
$3.89 for Kindle. Get Started Investing.
That's an absolute bargain.
And no, we're not choosing what platform. We support all platforms. We're always going to promote the biggest bargain. So Booktopia, Dimmix, Angus and Robertson. I actually didn't think you still were in business, but you are.
Our own website.
Our own website. We will promote whoever offers our book the cheapest.
There you go, $14.95. Sorry, Ren, it's up to $14 now on Kindle. Black Friday's finished. It's $12.99. But still
worth it.
Still
worth every
it.
penny.
Absolute bargains galore to be seen. Up 42% or more. Anyway, let's get stuck in. Let's bring
loose intro.
Let's bring in Jelena. Well, Jelena, welcome to Equity Mates.
Thank you very much. Thanks for having me.
Now, we've got a bunch of questions that have come through from the Equity Mates community. Thank you for sending them through. This is the last Ask an Advisor for the year, but if you do have any more questions, we can answer them in our email, so send them to ask@equitymates.com.
And this will definitely be coming back next year.
100%, yes, bigger and better. So today we're going to cover a lot of the questions that have come in about investing. We've got super questions and then some general questions. So let's start with investing, Jelena. One that we often get but feels like anyone new to the community is looking for an answer, and it's around buying shares for kids. So how do you advise your clients on different ways that you can buy shares for their children?
Mm-hmm. Thank you for the question. So I believe there are two best ways to do this, depending on how much you're working with and your tax position as well. So the first option would be just a regular trading account, whether that's through CommSec or whatever your preferred trading account may be, in the child's name essentially, and opening an account with their tax file number. And then what would happen is they are subject to minor rates. So that means you have to keep the income low. So as long as you earn less than $1,308 a year, you'll pay less than 30% tax. And you can do that via a growthy ETF, for example, like a NASDAQ 100. That's achieved 18% per annum for the last 10 years. So that would keep you below the higher tax bracket and allow you to grow some money there for your kids. And the other option would be investment bonds. So if you're happy to invest in funds and ETFs as opposed to direct equities, an investment bond product is sort of in between a super fund and a trust, where it gives you a concessional tax rate of 30% and after 10 years, zero tax if you hold it all the way through. If you access it before, you're just subject to the usual tax rates. But so it's accessible to you, but it sort of sits separately from your personal assets. There's no requirement to get a tax file number for your child. There's no capital gains event if you transfer it and change names.
Nice. Now, investment bonds have come up a few times on the podcast. Mm-hmm. What are some of the investment bond issuers that you think would be worth Googling and doing our own research on if we're looking just for some names to start our research? Yeah,
I think Gen Life is the most flexible and has the widest investment menu in terms of the managed funds and investment options available. They also have tailored investment bonds for particular goals. Like if you want to fund education, for example, or if you've got a broader objective to help your child, you can tailor the investment bond accordingly based on how long you're investing and those sorts of things, and the features of the products. Yeah, and then there's also Centuria, IOOF, a few other providers out there you can have a look at.
Yeah.
So the next one that's come in, what asset classes are you favouring for your clients at the moment?
Yes, so with this question, I would say we have a bit of a balanced approach, not to be boring. There are a couple of asset classes I'll touch on, but we have a very balanced sort of allocation at the moment, and that's in line with the house view. I agree with that view. I think it's very hard to predict what's going to happen in the next 6 to 12 months, which we never really know, but it's particularly tricky at the moment. Will there be a hard landing, soft landing, no landing? They're all possibilities. So I think firstly, be balanced across the various asset classes and between growth and defensive. Then maybe a slight tilt towards Aussie equities, and there's some interesting stuff in fixed interest as well. So Aussie equities, I say that because of the population growth story, and there's some foreign money coming in too, apparently. A lot of the fund managers based globally are looking at Australia and some of our businesses here, as well as fixed interest. So fixed interest, direct bonds, locking in some of these high interest rates. You can't always pick the top, but I'd say that the current bank bonds that are paying about 6.5% to 7% is pretty good for a 10-year bank bond.
Yeah, it's crazy. I'm on a mailing list from one of the bond issuers. they're all $50,000 minimum parcels, so I can't invest in any of them. But you're getting like a good bank paying 7% interest. It's like that's almost equity-like returns.
Yeah, and there are platforms out there you can access those bonds with a minimum of 50,000, which for some people might be high, but in a super fund you could do that.
Yeah, one day.
Yeah.
One day, yeah.
So I cut you off there, but we spoke about equities and fixed income. Any other asset classes that are sort of in the conversation at the moment?
Outside of that, I would say having some cash set aside, not too much, to be able to take advantage of potential volatility over the next 6 months and opportunities that are in the market. But not, again, balanced across cash, fixed interest, Aussie equities. Is where
What is not too much?
So slightly more than what your typical risk profile would say. So if you're balanced, it might typically say that you should have 5%, so maybe 10, a little bit more that you can play with, because, like I said, well, as we're raising rates, which will continue, we've seen inflation come down yesterday, but there's no doubt we're still above the long-term targets for inflation. There will be further rate rises, most likely, but either way, pain ahead from the rate rises we've seen and on the short-term potential volatility. So that's why we're having a balanced approach and some cash there to take opportunity of that.
And the thing with cash, like there's so many bad things about this economic environment that we're in, but the one thing is that having a 10% weighting to cash is no longer like a dead weight on your portfolio if you've got it in a high interest account and you're getting 5.5%.
Exactly. Yes, like a Macquarie cash account pays 4.5% to 5%, and that's liquid. You can access it every day, and it's not going to be sitting there forever. It can be put to use. And most of my clients have been overweight cash up until recently, and that's done them really well. They've outperformed the average investor.
Must be nice. Now, our community love stock tips, and we've got one that is just directly, do you have any stock tips?
Yep, I do. Yep.
Oh, you're doing great.
I mean, I'm more of a holistic advisor, but I'm always looking for some direct equity positions as satellite positions that can really boost performance and get people excited about investing too. So I'd say in the small cap space, we've got a stock called IPG, is the ticker.
Okay.
So they provide infrastructure for electric vehicles, so upgrading apartment block parking lots and installing battery. Anyway, enabling you to charge your electric vehicles in these apartment blocks, and they also provide data centers as well. So infrastructure in the tech space, and it's been hit hard the last 2 months. Has come down about $1 from its typical trading price, so I think it's definitely a good opportunity.
Nice. Confusingly, the ticker is IPG, but the company's called IPD.
Correct. And then there's another company called with the ticker IPD, Impedium, which is a healthcare stock, not that one.
Okay. Not to be confused. It looks like it's been on a bit of a run in November, up 30%. So there you go. Stock tip IPG. The company is called IPD, though.
The ticker is IPG. Let's just stick with the ticker. All right. So it's obviously been quite a volatile, sort of, I guess, 12 or 18 months now, really since the start of 2022 and when rates started rising. Investing got a lot harder. So what are some of the common mistakes that you're seeing clients make? And I guess the flip side of that are what are some of the habits and mindsets that you're trying to instill in your clients in this time?
I think it comes back to before you start investing as well. So obviously the classic panic selling at the wrong time, and we've seen that markets recover pretty quickly. Like in the COVID recovery, the market took 3 weeks to recover, a V shape. And if you were trying to time yourself back in, it's very easy to miss that. A lot of people did. And I mean, the GFC took 2 years to recover, but times are different. Things are moving quicker. We've got algorithm trading. We've got all sorts of things going on. Trying to time yourself back into the market is tough, in my opinion. So I think you need to be careful about panic selling, one. And the way to avoid that, in my opinion, is before you start investing, be well aware of the risks. Have an emergency fund set up so you've got that base that you're comfortable, that you have enough there, even if you were to lose your job, and the money you're investing with, purely use that to grow and know how much you're risking. So in equities, it can drop by half, as we've seen in the GFC or the COVID correction. And then be prepared for that to happen, but you know you've got your emergency fund set aside and you've got a long-term target that you're aiming towards.
And how do you advise your clients where to put their emergency fund and to know how much their emergency fund should be able to cover in terms of months off work or whatever it may be?
Yeah, I'd say about 3 to 6 months of your expenses. But the reason behind that is that's how long you typically would take to find a new job. Statistics show that. I think it's more US based, but could be applied here. That's how long typically it would take you to find a new job and be settled and start receiving a regular income again. So, and then in terms of where to place that, somewhere liquid, like Macquarie cash, high interest cash account, or an offset against your mortgage.
Yeah.
As two people who have just got mortgages, I literally set up my offset account this morning. It's a very daunting world that we're entering.
Yes.
Anyway, that's a separate conversation.
And staying on separate to, I'll just add on to emergency fund, income protection. So emergency fund only lasts you 3 to 6 months, and it's based on if you're out of employment, let's say, or whatever reason your income stops. What about health issues that stop you from getting a new job? That's when income protection kicks in. And if you get a policy all the way to age 65, it means between the emergency fund and income protection, you've got a safety net for the rest of your working life.
Yeah.
It's actually something that is on my list of things that I'm doing at the moment because I don't get it through my super because of when I set the super up, it wasn't an option. And to get it in the super, I need to close that super account down, move all the money out, come back in. So that's really frustrating, and it's something that I'm considering doing. Or I can just go and get a policy outside of super.
Yeah, that's right.
But there's a fair bit to it in terms of understanding what type of cover you need, how much you need, if it's going to scale as you get older, the health that you're at, blah, blah, blah. So it's not just your classic...
But when people are in their super fund, they get it through their super fund, they're not going... Are they choosing all of those things? Isn't it often just like a tick box?
Yeah.
The income protection policies in super are much simpler, definitely. But either way, if it's in super or outside, it's giving you a monthly coverage.
Yeah.
Yes, there are a million different tweaks to it. It doesn't need to be overcomplicated though. Just make sure you're covered for enough per month to cover your expenses. And then it's up to you. If you want to be covered all the way through to retirement, age 65 is the benefit period to go. All the other tweaks, bells and whistles, don't really matter too much, in my opinion, as long as you've got it. And if it's tax deductible. So if you pay for it personally, it's tax deductible to you. If you're preserving your cash flow, and that's the goal of yours.
That's kind of what
then you can pay for it through super. It's tax deductible to the super fund. Or you can actually split it, have both ways, have half of it through super. Anyway, but the main product providers, TAL, MLC, main insurance providers all offer you pretty straightforward income protection cover. And that's, I would say, an extension of an emergency fund that everyone needs.
Yeah.
Nice. Well, there you go. I learned something there. So it's tax deductible if I pay for it out of my cash flow.
Yeah.
And often people lose it. I've had quite a few friends and family recently looking to consolidate their super, whether it's an SMSF or a fund where they've got more control over the investments, and they just want to click the button to consolidate. And there's a warning there saying you may lose your insurances. You will lose your insurances. Unless you replace them, you will absolutely lose them. So it's definitely worth looking at, especially at the time. If you're looking at putting a super together into another option, look at the insurance as well.
Are there any other insurances that are tax deductible?
Life and TPD is
but
tax deductible to your super fund only, not to you.
So not to you personally?
Not to you. So that you'd pretty much always want to fund that through super, bar a few different scenarios. And then there's trauma is the last one, which is not tax deductible at all. You have to pay for it yourself. You can't pay for it through super. But it's sort of a fourth type of cover. If you want a full safety net, there are some cases where income protection won't pay you. So the criteria is you have to not be able to work. And there are some cases where people fall ill and they are physically able to do their job. So trauma gives you a lump sum upon diagnosis.
Nice.
Final part. Yeah.
Good 101.
There you go.
Yeah.
So we're speaking of super. So let's hold on super because we always get a few questions about super. The first one was very general, I guess. And it also leaves it up to interpretation. So I'm going to be interested to see how you've taken it. How do the top 3 super funds compare to an ASX 200 or S&P 500 ETF over 10 years? Now, the 2 ways that you could take it, the top 3 super funds, you could say top 3 is in biggest, like Oz Super
Lowest
and stuff.
fees.
Or it could be the top 3 best performers, which I actually wouldn't be able to tell you off the top of my head. So I'm interested, which way did you take it? And then how did you answer it?
Sure. So I had a look at the top performing super funds,
nice.
which was alarming. Over 10 years, Australian Retirement Trust achieved 6.4%.
Is this all their balanced options?
This is their balanced.
After fees?
After fees. Oh, this is after investment fees, not after account fees, just purely the investment return.
Okay.
Aware Super was 6.3, Uni Super 6.2.
Over a decade.
Over 10 years,
Like
per
per
annum
year,
return.
Lower than I thought.
Yes.
Yeah.
I think the last year and 5 years are pretty good, but over a 10-year basis, that's what they're saying. And in terms of ASX 200, what's interesting is IOZ, like I said, one of the main ASX 200 ETFs, actually has a similar return, 6.5 for 10 years.
Is that excluding dividends though?
Yes, I would say. But it's per annum return. So anyway, but then S&P 500 much higher, 11% per annum. So the answer to that is if you're in a diversified portfolio, you achieve better than what you would in a typical. Just better. If you between international Aussie.
Oh, you mean diversified between ASX and S&P 500?
Let's say 2 ETFs, S&P 500 ETF, ASX 200 ETF, you would beat.
The
industry fund.
Yeah, but I guess it's an important reminder that choosing the right setting on your super is important. And, you know, whilst everyone's situation is different, in general, when you're young, you have the capacity to be more aggressive.
Correct, you do, and you've got a longer time frame. You've got cash coming in, so you know how set cash aside is a good idea at the moment. I sort of mentioned that earlier. Well, if you're employed and you've got super guarantee coming in, don't have to worry about that. You've got cash coming in, and that can work towards adding to a share portfolio or paying down debt. If you've got a self-managed super fund, you pay down your debt quite quickly because you've got regular contributions coming in, and similar for a share portfolio, you're adding into that portfolio regularly.
So with a self-managed super fund, you can borrow through a self-managed super fund?
You can.
People buy investment properties and stuff through self-managed super.
Yes, you can. And one of the unique things about a self-managed people don't realise is you can pool your money together as well with your spouse or sibling or relative that you trust.
Dude, we should do an SMSF together.
Sure, bring in our wives and partners as well.
We can all get one house, maybe.
So you can borrow. It's called limited recourse borrowing though. So it's a bit tighter than borrowing your personal name in terms of how much you can borrow, and ultimately it's still within the super environment. You can't touch that asset until you retire.
even the cash flow generated from the asset has to go back into the super. You can't use that.
It's all under that super umbrella. But within under the umbrella, you can do many different things as an SMSF, including borrowing to buy a property.
Well, on the super theme, and related to the first question, what is the best way to compare super funds?
Yes, so advisors do this all the time, but if you don't want to pay for an advisor, what we do as part of the process is we have a list of questions, hard questions, that we use to call up the super fund and ask them. So the balance, obviously, and then ultimately, like where you're invested, currently where you're invested, look at the performance of that, but also how many investment options are there available in the fund, and then fees obviously as well. But you know, interesting thing about fees is they vary between 1% and 2%. Performance varies a lot more than that. So it can be 10% difference between A fund performance and B fund performance. So performance does come into it even more so than fees. I would say, and availability of investments, how many investments, and then ultimately other things like, is there a binding nomination available, insurance options, long list of questions that matter to you, and then sort of just ask that across the different funds and compare it that way, I would say.
Without calling the super fund, it's often quite hard to get a clear view on what they are invested in. They'll say Australian securities or private equity, but it's like, what is that? And so it feels like the solution is you've just got to give them a call and find out. But
even in that case, though, yes, they'll give you certain information, but that's one of the downsides of industry funds. They are cheap and a great solution if you're under a certain balance, in my opinion. Once you've got over $100,000 or thereabouts, maybe even less than that, you could be looking at other options where you've got more transparency. It's your hard-earned money. You don't actually have a right to know in some of these investment options. That's the way the industry funds are run.
What other options?
Other options are wrap super funds, where they wrap the reporting up for you. That's the term wrap is used for that. They do the reporting for you, but they offer a very wide sort of list of investments you can choose from and manage it yourself, essentially like a self-managed, but without the tax liabilities and paperwork that you have to do when you're running a self-managed. And the cost is sometimes similar. We don't realise they call them retail funds as well, or super wraps. The cost can be quite similar to an industry fund, depending on which industry fund you're in.
Yeah.
And the investment options can be hundreds or thousands more than what you might have in your industry fund.
Yeah. We actually had another question around industry funds, not just about investment options, which I agree, it's often hard to find. And then you open the AFR and you see that Australian super is now like standing in the way of Origin's acquisition. And it's like, well, that's, where do you see that show up in your investment report? But anyway, that's another conversation. But we also had a question about finding out all of the fees that you get charged. And sometimes it's hard to find all the different fees to do like a true apples to apples comparison. The person that asked this question was actually looking at going back from an SMSF to an industry fund, but was struggling to do it. Short of being an advisor and speaking to someone, how do you get a good view of all the different fees that you might be charged?
I think there are two main fees, really, but they just sort of change the wording in them, and sometimes they divide them up. So the two main fees are investment fees and then product fees for the super fund. And the investment fees, they're obliged to tell you. They have to tell you. And sometimes what they do is they might split it between like an asset-based fee and then another fee, but really it's just an investment management fee. So if you just ask what's the total investment management fee for a fund that you're in, they'll have to disclose that to you. And the other layer is the product fees. So again, that can be called an asset-based fee, admin fee, account keeping, but the total administration fees, product fees, they must disclose that to you. So they're the two main ones.
Well, we're going to take a very quick break, and on the other side, we're going to cover questions around debt recycling, the worst financial advice you've ever heard, plus more. So we'll be right back. Welcome back to Equity Mates. We're here with Jelena Koncar, Senior Wealth Advisor, Holistic Advisor at Shaw & Partners, and we've been covering questions from the community around investing and superannuation.
I love it, and this is a reflection of us and our audience. It's like we have a holistic wealth advisor that can advise on all aspects of like personal finance, building your financial house, but we're just like investing in super. Tell us about the stock market.
I know. Maybe next year. As I said, the series will continue next year, so please keep the questions coming. ask@equitymates.com is where you can submit them. Now, we've got a few just general questions to close out, Jelena, and the first one is, it's a good one. If you were to give a gift this Christmas to someone to help improve their financial well-being, what would you give?
I would give a safety net, i.e., emergency fund and insurance policies. That's your safety net so that you can move forward and invest with confidence.
You'd give someone their emergency fund.
Well, yes,
That would be
an amount to work towards
Here's
it,
a
I
bunch
guess.
of cash for your emergency fund.
Yeah, I don't know. Maybe an invoice, a voucher to see an advisor to do that for them.
Yeah, I think that'd be a good one.
A voucher to go and see an advisor to help them achieve those two things.
Do you do vouchers?
I did in my last role.
Yeah.
I'm really busy at the moment, but perhaps we could reintroduce it. Maybe we can reintroduce it.
Yeah, it'd be a good one.
Yeah.
I imagine a lot of parents would be buying it for their like early 20s kids.
Yes. I think it's worth it. I mean, sitting down with an advisor, I think an hour or half an hour with an advisor can open your eyes as to what's available out there and what you should be thinking about.
Someone in our office went to an advisor, one of the advisors that we've actually had on the show, and she was skeptical. and came back and raved about it. Yeah.
Okay.
So
Yeah.
For that
Yeah.
reason, what she thought she would get out of it.
having
got
like working
completely
here at
different
Equity
things.
Mates,
Yeah.
didn't think she'd get much out of it. But
And the advisor opened her eyes.
And going to an advisor that has a broad range of areas of advice
Yeah.
is useful, I would say.
So we've got this question a few times. It's not something that I'm super familiar with, but that's okay. I'm not super familiar with a lot. So it's about debt recycling. What is it, I guess? Let's start at the very basics. And then when should people think about it?
So it's the concept, the term debt recycling is sort of moving your debt from being non-tax deductible to tax deductible, like throughout your working life. And you can do that as you build equity in your home. You can borrow against that home and invest it into an investment property or a share portfolio, which is an investable asset, and that debt becomes tax deductible. And the idea is that asset grows or pays your income, allows you to pay off your non-deductible debt faster. So
Okay.
that's the idea
So
in a nutshell.
In plain and simple terms, it would be we have a home loan, we build some equity in that, and in a few years' time, we then redraw that or borrow against that to buy growth stocks.
Yep.
Or an investment property.
Or another investment property, a investment property.
Yeah.
And then because that's used for investment purposes, that debt is then tax deductible.
Correct. And that asset will likely grow. It's supposed to, according to statistics, the stock market, double-digit returns, depending on what time frame, but at least 8 to 10% return. And a property is similar, I'd say. And then the interest you're paying is less than that. So over time you're ahead and you're paying down your debt faster.
So I think that's super important. You wouldn't do it in a scenario where the expected return on the investment is less than what you're paying in interest.
Correct. But then you have to look at this as a medium-term investment. You're not investing in shares or property for less than a year or less than a few years' time, ideally. And over that time frame, it should achieve more than what the interest you're paying, generally speaking. Yeah.
It's funny when you think about it from a policy point of view. And I know none of us are here to design government policy, and it's just about maximising your financial circumstances within the policy parameters that we have. But when you think about it like that, it's strange that an investment loan to buy a house is tax deductible, but a loan to buy a house for an owner-occupier isn't. Just from a policy point of view and how we're trying to what incentive structures we're trying to build into the system, it seems strange. Yeah. Anyway, let's not get down that rabbit hole because
it'd be ideal if it was owner-occupied as well, but anyway.
I mean, it would be great. Yeah. Or if it was you wanted to take the heat out of the housing market, you'd say, well, this just gets into the whole negative gearing.
Yeah, exactly. That falls into that category.
I would be all for making more incentives to make stock market investing more. Anyway.
And so do you see a lot of clients doing debt recycling?
Not really. So often we have to open their eyes to it. They've got available equity. They've got a high income. They've got an emergency fund. Why aren't they doing that? They could unlock some capital there and grow their wealth further and faster and pay off their debt their non-tax deductible debt faster.
Good.
A new concept.
Something to think about.
Yeah. We're still a little bit away from that. I think.
Yeah, I was just thinking, I haven't even paid one mortgage payment yet. So.
Well, I guess that's probably a good question because a lot of people listening would be a little bit further than Bryce and I, and they've started paying off a mortgage. How much, maybe as a percentage of the house or of the apartment, how much equity should they have before debt recycling becomes part of the conversation?
I would look at it as a dollar figure, but if you've got a couple $100,000, that's enough to do something. I would say. I mean, if you're being cautious with the share market, you could do it in stages. You could do it in $100,000 lots to dollar cost average into the market to minimise your risk in terms of investing. And like we said, it's a volatile time. So we don't know. It could be difficult 6 to 12 months in markets. You could go backwards.
Yeah.
But if you're doing it gradually, then you're more likely to achieve a better result on a 2 or 3 year basis.
Yeah.
Take it out and buy the 8% bonds that are getting...
Yes, exactly.
Yeah.
So we actually have clients who are doing this, borrowing into bonds. It's a very safe investment, and ultimately you're achieving 2% return on something that net after the borrowing costs.
You're borrowing for 6 and you're
whereas you achieve nothing if you weren't doing it at all. So
yeah. Well, you're achieving the 2% net and you're getting the tax deductibility
correct.
for the
Yeah,
6.
putting in a tax position where you're doing it, if you're doing it in personal name or super.
It's interesting. All right, well, I'm glad we asked that question because it's opened my eyes. The final questions we have are, I guess, two sides of the same coin. We'll ask them separately, but they're the best and worst pieces of financial advice. Let's start with the worst so we can finish on a positive note with the best. So you've been an advisor for a number of years. I'm sure you've heard a lot of advice and I'm sure you've heard a lot of opinions from clients as well. Mm-hmm. What's some of the worst that you've heard?
The worst thing that I've heard and that bothers me the most, especially at the moment, is when people are certain about the future, when they sort of they're so adamant about a particular outcome. And that includes professionals more so than clients. That irks me the most. And it's so transparent when they're trying to push their own product, but clients could fall for it. I mean, if you sit there listening to, let's say, a defensive investment fund.
Name names.
I'm not going. Let's say a defensive value style global equity fund. Value typically is more in favour when times are tough. So they're naturally bears, trying to promote their own fund, saying markets will be down 30% next year. Yeah. That's a typical example of a bear and pushing their own product. And they're very adamant on the fact that it's going to be down. And I'm like, hang on a second. What about my clients that obviously that we see a potential scenario of soft landing, hard landing, no landing, and various economists around the world have all these different opinions. Why are you the expert?
Yeah.
How do you know what's going to happen? And it's transparent, basically.
Nice. Yeah.
So avoid people that have certain predictions about the future.
They're too certain about the future.
I like that.
Yes.
Yeah.
Well, on the flip side, what's the best piece of financial advice you've had?
The best piece is from one of my idols, Susie Orman. She's a financial expert from the US.
Okay.
Her main sort of saying is people first, then money, then things. And that sort of the point of it is you should put your relationships first. Money is the next most important thing, having financial security, and things are last. So really, when you go to buy that thing you don't really need to impress the person you don't really care about, think twice about that.
Yeah.
Awesome.
Love that.
Great way to finish. Well, thank you so much, Jelena. It's been an absolute pleasure. And thank you again to the community that submitted all of those questions. Ask@equitymates.com to keep sending them through, and we'll make sure that we get them in for the first episode back in 2024. But it's been an absolute pleasure. Thank you very much.
Thank you. Thanks for having me.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.